this has, again, as some would suggest, the makings of a go big or go home market right now, just because of where rates have backed up to. If volatility is going to pick up, why wouldn't you stay with the largest stocks, most dependable in quotes, within the market? Maybe that steers you to the mega caps, which you've been adding to, by the way, like Apple, which you added to again.
I did, and I'm now overweight in Apple.
Okay.
Just because it's underperformed so massively, and I do think it's underowned relative to its historical average, where I think the rest of FANG actually is pretty well owned. And I actually took a little bit of Amazon profits and put it into the Apple because I do think the risk reward is better. The numbers have been coming down. We know how bad China is. They are eventually going to fix it. I still think they're going to be able to grow double digits in earnings with record margins in the face of really challenging environment. We have services that we have to look forward to in terms of double-digit growth. We have AI to look forward to. Look what happened last week when they talked about Mac and having new products with AI. It was up 4% in a day. I mean, one of the biggest days that it's seen in over a year. So to me, I'm looking for places. It's not necessarily all of the FANG and all of, go big or go home. It's trying to pick some spots where I think there's really good value and good risk reward. Apple, I think, is one of them.
Jimmy, long Mag 7 continues to be the most crowded trade. And that, again, according to the same fund manager survey that I referenced just a moment ago, the one that was the most bullish in the market since January of 2022.
I think we need to retire the name for the obvious reason that Tesla is just
you could take
but
you could call it the Fab Five, whatever.
I think this,
you can do whatever you want.
Extends,
the point
I think this extends the comment that you started with the show. Do we need to change the playbook? Should we change from the broadening of the rally back to the narrowing of the rally? I've given my answer. I think the answer is no. Having said that,
what's up today, by the way? I don't mean to cut you up, but what's up today? Nvidia's up, Microsoft's up, Meta's up, Amazon's up, Alphabet's basically flat, but
Apple?
At a point of, Apple's had its own issues. At a point of alleged turmoil within the market, the safety trade has been back big. Mega caps. No. I mean, today, if you want to pick today, I'll explain to you. If you want to pick today, that's fine. But take a look at beloved Nvidia, which I like a lot, and I'd like to add to it. This has been the most defensive trade in the market for the last year and a half.
Well, what's it off from its recent high?
It doesn't matter if it's off from its high.
How can you say it doesn't matter?
It's been the most defensive trade in the market.
That's
why the stocks have worked more than anything else.
Hang on, Josh. I'm in it with Scotty. I got to finish this, okay? The market, God, you killed me today. The market's down 4% from its peak if you measure it from the S&P 500. What's Nvidia down from its peak? 10%. Stop it. It hasn't been defensive. Not in this pullback.
Not within this most recent market upset.
Look, that's what we're talking about.
There's a reason why these stocks dominated the conversation for as long as they did. And investors have been able to play both offense on AI and defense for safety and good balance sheets through a lot of market turmoil, more so than any area of the market.
But not recently.
Prove to me otherwise.
Not recently.
Not within the last few weeks or a month of the backup in rates when we started talking about higher
Now
for
I'm the
longer.
short-term guy.
But it used to be that Mag 7, they were the only game in town in terms of earnings. Everybody else didn't have really good earnings.
Well, the most dependable ones.
And so now, and I'm talking, and now, fast forward, look back at fourth quarter. If you look at energy, financials, industrials, they kept up with technology. That's my point. If earnings were terrible in these sectors, or you didn't have a lot of visibility in these other sectors, that's one thing. But you actually do have better visibility in these sectors, and you have pricing power, and you have free cash flow generation, and you have debt pay down. These are stories that are, this has happened in tech, hasn't happened in these other sectors, but now it's happening. So that's why I'm saying, it's broadening out, and that's very exciting, actually.
But the earnings, I think the only point I'm making, the earnings durability has been way more reliable in mega cap tech than it has been to any of these other sectors over a longer period of time.
100%. That's why they call them cyclicals, because they're not. But at least if you get the cycle right, you can make a heck of a lot of money.
Josh, quick, and then we're going to take a break.
Sorry to be annoying. You are right. James is off. The Magnificent Seven, there's an ETF, very simple, MAGS. So if we want to speak about this group colloquially, just equal weight them in the ETF. They're up 15% year to date, which is better than the S&P, now 6. I'm using the SPY. And even in this recent pullback, they've held up better. They're like 1% off the high. The S&P is more. So I think, look, Tesla's an eyesore. Apple does have its own issues, but Scott is right. People are using these stocks, whether they should or shouldn't, we'll find out. People are using these stocks on days where there's volatility. They're clinging to them like a candle in the wind. That's undeniable in the price action. I'm not saying they should. I'm just saying they are.